Oh gosh, okay. So, before we talk about the questions you need to ask yourself before you fundraise, we're going to look at who the investors are that you're going to be raising from and what they want. So, we're going to be focusing on two different types of investors. One is angel investors, and second will be VCs. So, angel investors, who are they? Now, I'm going to add a little warning sign before I dive into this. This is particularly focused on the UK market. US market has a different profile of angel investors because there's additional regulation which prohibits the majority of people in the US from being able to angel invest. So if you are from the US, you can message me afterwards. As you can probably tell, I'm also from the US, and so I'm happy to chat about that afterwards. However, angel investors typically have these four profiles, or these four reasons to invest. One is they are focused on SEIS and EIS. If you don't know what that is, don't worry, we'll talk about that. They may be a serial angel investor. So these are people who have large portfolios of investors, or large portfolios of startups that they've invested in. They might do it full time, or they might devote a large portion of their time to angel investing. The third might be exited founders. Now, these could also be serial angels as well, but these are typically founders who have exited, they have a bit of extra cash, and they want to offer hands-on support to the founders that they invest in. Usually, these are also founders that have been burned, shall we say, by VCs. We see that a lot, and so they're keen to come in and help founders avoid the investment pitfalls that they had. And then the fourth are domain experts. And so these are people who have, you guessed it, a lot of expertise in a specific fields, and they might be driven to invest by a personal pain point that they felt after working in a field for a certain amount of time, or they have a lot of knowledge about something and they can see the opportunity in startups that people without that domain expertise might not be able to. Okay, so they typically invest for at a minimum of one, but perhaps all four of these reasons. So it's typically going to be a mixture of mission, team, money, SAIS, and EIS. So with mission, they might be driven by a particular cause, or a specific opportunity. So like a domain expertise, like let's say that you've been working as a oncologist for your entire career, and there's a startup working with some new cancer technology. That might be a combination of mission and money, and they're going to be a domain expert angel investor. You don't have to like memorize all this stuff, but it's just helpful to have a better understanding, and so you can kind of profile the investor that you are speaking with and understand what they're going to be looking for in your pitch, because it does vary a little bit, and we'll talk about that later on. The second one is team. So this might be because you've worked with them for the past 10 years and they were your boss and they believe in you, and so they want to back you. It might be someone in your family and friends network, or it could be someone who you don't know at all. However, they see that you've had a really impressive career, and that you've shown that you have incredible capabilities in other ways. So team is really going to be all about who you are and who you know. The third is money. And so this is going to be focused on returns. So how big is the potential upside for the investor putting the money? And the fourth is SAIS, EIS. So these are tax schemes which make it incredibly advantageous for angel investors to put money into startups. And so they get typically, this for SEIS, they get 50% off of what they invest into your round off their tax bill, and then that remaining 50%, 50% of that remaining 50% can potentially be a write-off if the company fails. Those other tax benefits, we can link to all that afterwards. I won't go into the details there. However, it essentially just limits the downside of an investor if your startup were to go bust, which hopefully no one will. However, it's been a really massive influence for getting more people in the UK keen on angel investing. This is also really important to know because the SAS and EIS tax scheme goes from April to April, or like April to end of March, whatever those dates are. And so sometimes you'll find a pickup with with these type of angels around February and March, when they realize they have a bit of excess with their SEIS. So the limit is 250K. So angel investor can put in up to 250K and receive these tax benefits. So if they've only invested 150K and they realize, hey, I have an extra 100K sitting around and I have 2 months to spend it, that can help speed up deals. Alternatively, if they've maxed out their 250K at the start of April, we typically see a surge of SEIS and EIS investments around that time period as well. So let's move on to venture capitalists. And yes, VCs really do just want the money. However, it's for a good reason. It is literally their only job. So VCs, I'm going to talk a little bit about how the VC business works. So VCs essentially take money from LPs, limited partners. So these are essentially their investors. So that the GPs, who are the owners and the founders of typically the founders of their fund, they go around and they source investment similar to how you all are going to go around and source investment. However, they're taking on significantly more investment. And traditionally, the LPs are going to be endowment funds, pension funds, sovereign wealth funds, charities, and also coming from wealthy individuals as well. And so I think this is important to know, because many times we hear from founders this perception of that they're going out to make money for all of these guys who are already super rich, when in reality the people they're making money for can be pension funds and charities. And so there's a lot of good causes that benefit from VCs, but that said, in order to benefit the LPs, they are hardcore about making the most of every single dollar in their fund. So quiz time. Can anyone name a few of the largest LPs in venture capital funds? You can stick it in the Google chat. But I'm just going to give away the answer right now as well. So in 2000 up to 2017, the largest LP was the European, it's like the European Union Fund of the European Sovereign Wealth Fund. However, since then, the largest LP in North American funds has become the Ontario Teacher Pension Fund. And so, and within like the top 10, there's also there's like 2 universities or 3 universities. There's another teacher pension fund. And so again, it just kind of reinforces the idea this is not some you're making money for a lot more people than who you're just pitching when you're speaking to VCs. Okay, so now we're going to get on to what this talk is all about, which is the questions for you to ask yourself before you fundraise. So the first question is, do you want to make as much money as possible? The second question is, what's your ideal life in a few years? And the third one is, have you done the work? So we're going to start with the third one. This is supposed to be an image of our hotbed astronaut doing the like little Uncle Sam point straight at you. However, Midjourney really failed me this time and it's pretty lame. But anyway, it's pointing at you, asking if you've done the work. And so this is really important, because even for really early stage investors who are pre-seed, there's this notion that founders on day one are going to get funded. And truthfully, unless you've had a successful exit before, you have incredible team members, or you were maybe a first employee at like a large scale up, it's unlikely that investors are going to back you with just an idea on paper. And that's usually because now with tools like Bubble and so many no-code options out there, it's really made the cost to produce your MVP drop dramatically. So investors are going to expect you to be slightly further along when you come for your first pre-seed round, or maybe friends and family round before then. And that's not because they're becoming like risk adverse. It's more because the competition's got tougher and there's a lot more founders who are able to do more with less. And so from the investor's perspective, not only do they de-risk their investment a little bit, but they're also seeing the kind of hustle that you as a founder have. And so it's really important that you've done as much as possible before you go out and raise your pre-seed round. Now, there's some exceptions to that. Well, there's a lot of exceptions to that, but that's kind of like a rule of thumb. Do as much as you can to make the strongest case to investors, and we're going to dive into that later on why you want to do that. But equally, like, don't prolong the investment. Like, once you get to a point where you need money, you need money. But usually for most founders, that point is going to be slightly further along than they expect. Okay, so now the other two questions: how much money do you want to make, and what is your ideal life in 2 to 5 years? So the first question on there: how much money do you want to make? In order for VC's business model to work, you have to aim to become a unicorn. Now, this is kind of an unspoken rule that VCs don't tell founders, but a lot of times during your pitch, a VC, if they haven't heard of the pitch, is going to ask, okay, so how far do you think you can take this? What's your big idea? And if they don't hear you saying $1 billion company, their business model or your business model with their business model simply isn't compatible. A good little back of the envelope math that I like to do in my head is you can look up a VC, you can see how large their fund is, and typically for every $50 million in a fund, they need to see about $2 billion in returns in order for that to make sense. So you can look at it like you at the exit point, you would typically see VCs diluted down to around 10%. And so from a $2 billion worth of exits, that's down to about 200 million. And so 200 million, and then you subtract the 50 million, which is the capital they paid in, and you're left with about 150 million. So they've essentially like 3x the amount of money they have, and that would be like a decently performing fund. So you can just see that those numbers, and also within their total number of investments, they're expecting most of them to fail. And the majority of the returns are going to be made up by the small number that succeed. So the small number that succeed have to be aiming for the $1 billion exit. Otherwise, they have to turn around to the LPs and they're like, hey, pension fund, sovereign wealth fund, really sorry, we just lost your money. By the way, we're raising our next fund. Do you want to invest? You can guess what the answers are. It's probably going to be no. And so it essentially kills their company when they hear that they have no founders in their portfolio exiting or focus on the 100 or the $1 billion exit. Now, for angels, it's a little different. Angels can usually make, honestly, better returns. I wouldn't say better returns, but if they're not reinvesting in future rounds, they're probably going to be so diluted by the $1 billion round that having earlier exits is probably a little bit better for angels. And so, however, a lot of angels will still want to see that you have the $1 billion ambition, just to kind of get a temperature reading on you as a founder. But that said, be honest. Again, these questions are not phrased today as trick questions. We're not telling you what the right or wrong answer is, but it's just really important that you've had time to consider this and figure out what's right for your company and what you want. So that kind of leads on perfectly to work-life balance. And so most investors, in order to get the $1 billion company, are not expecting you to exit for the next 5 years. Probably at the very earliest, it's going to be probably closer to 7 to 10 years. But the reason on the earlier slide, we specifically said your ideal life in a few years is going to be because whether you're pitching to an angel who might be okay with the earlier exit or a VC, for the next 1, 2, 3, 4, 5 years, you are going to be expected to be working your ass off. Now, that doesn't mean you can't have a healthy life and have, a wonderful outside of work life, but they are going to be expected. If they put their money into you and they're choosing to invest in you over another founder, they're going to want to see that you're totally committed. Okay, so these are a few questions for you to also ask yourself. However, it's just more of stuff for you to chat about with your team rather than think about in regards to investors. So first question, are you prepared to raise for several months full time? Are you comfortable hearing a lot of no's, and which co-founder will raise full time? So the reason we mention full time is because you guessed it, raising is typically a full-time job, especially if you're raising pre-seed round rather than like agile funding. You're going to be speaking to investors nonstop. You're going to be, and this kind of leads into the second question too. Are you comfortable hearing a lot of no's? We've seen a lot of founders pitch to 100, 150, 200, up to 300. I think 350 was the most amount of investors we've had a founder speak to, and she did close the round. And this is really important to know because other investors, you're going to get hopefully a lot of investors who take a second meeting and then a third meeting and have follow-ups, and they want to see the data presented in a different way. And they want to meet you at the specific time, which is tomorrow, which is just an hour before you have another big meeting. And so you have to prep for both meetings, but you also have a client call. And then you also need to change a website design. There's so much going on, and you're going to have to be responding to last minute stuff. And you're going to have to be responding to someone who's also judging you at how quickly you're responding and how high quality the information that you're responding with is. So as you can see, it's a massive time commitment for most founders, not for everyone. Some will close faster, and there are some strategies you can use to close the round faster. However, you need to be prepared to block that out. And so obviously these questions are phrased with the assumption that you have another co-founder. For founders who are single founders and are raising, this is challenging. Like, this is definitely going to be a challenging time for you, and it's probably going to be quite stressful. I don't have too many words of wisdom in that department, other than it is doable. There are solo founders who raise, so don't let that stop you. However, this is a big benefit of having a co-founder is you can have someone who's actually managing the business. Because remember, if you're focused on fundraising for 5 to 6 months, investors are still going to be expecting and tracking your business on week, maybe month on month growth during that time. So having that powerhouse co-founder who can drive the business forward during that time is critical. But again, solo founders, it's been done before. I believe in you. And so that other question, are you comfortable hearing a lot of no's? Reminder, as I said, if you're pitching hundreds of investors, then you're probably going to be closing with anywhere between like 3 to 10 investors. That means the vast majority of investors are going to be either saying no or not responding to you. Most of them are probably just going to say, no, it's too early for me, come back when you have more traction, or just going to ghost you. But you have to be comfortable taking that. Okay. So we're getting to the end, don't worry. Investing in your startup means not investing in another startup. So this is a really important framework to think about if you're an investor. An investor has to be so confident in you that they are believing in you enough to put money in you, as opposed to the other startups who are pitching them at the time, and also the startups who might come to them the day after they sign with you, 6 months after they sign with you, a year after they sign with you, and they're going to have to say no to that founder because they invested in you, which means there's an opportunity cost for investors. And so they're only going to invest in you when they believe they're more likely to make money from you rather than another startup. And so make sure you bring your A game, but don't worry, a lot of you might be feeling like this right now. However, by the end of the week, our goal is to get you feeling like this. Nervous, but you're going to be excited. Reminder, it is doable. We made today a little bit of a scare day just to prepare you for the work that is necessary. However, founders close all the time. And we've got a lot of stuff prepared for this week for you guys to end the week on Friday feeling a lot more comfortable, a lot more. I tried to combine the word comfortable and confident, but anyway, confident and comfortable. Okay, so with that, we will, I forgot I had these slides, just the takeaways. Okay, I'll leave that there. We'll end there. If anyone has any questions, it can be about what we talked about. It can be about this program, anything else you want to add, go for it. Otherwise, we're going to head into the peer-to-peer sessions.